Nikko AM Singapore Dividend Equity Fund invests in stocks which offer an attractive dividend yield as well as a reasonable level of growth. We look for companies with strong business models which can offer a steady stream of earnings and dividends over the economic cycle. We also have a differentiated total return approach, meaning that the bulk of the fund is invested in dividend anchors that offer an attractive dividend yield. A smaller part of the fund is invested in dividend growers, which we think will deliver strong dividend growth over the near term due to improving earnings or cash flows. Singapore is one of the best markets in Asia to harvest dividends. It is a highly developed economy with well-managed companies that have a strong dividend paying culture. It's also one of the highest yielding markets in Asia. So over the years, we've found that the dividend yields actually offer a significant boost to investment returns. Lastly, it features a very strong REIT sector, which also offers high dividends that can enhance returns for investors. We are positive on the Singapore economy and Singapore market. This year, we are seeing a sharp improvement in economic data, and that's because of the upturn in the global trade cycle, mainly in the United States. Of course, it is supported by the recovery in major economic regions, including the US, Eurozone, and China. The improvement in exports bodes well for corporate earnings, and after 2 years of downgrades, we have seen this year that earnings expectations are upgraded. We see valuations as being reasonable. Price to book is still close to the crisis low. Price to earnings is closer to average, but we think this is still attractive given that earnings expectations are. Our stock selection strategy focuses on 3 areas. First, we like to invest in the new Singapore. These are companies which will do well in the economic environment of the future. They tend to be in services sectors like healthcare and logistics, but also in food, data, and technology. Second, we like exporters, and that's because of the upturn in the global export cycle. And these are companies in technology or consumer staples. Lastly, we like restructuring candidates because we believe that the pace of restructuring and M&A will accelerate because companies want to gear up to take advantage of economic upturn. Yes, it's true that rising interest rates are often seen as a threat to dividend stocks, but we believe that the reason for the increase in interest rates is more important. What we're seeing now is that interest rates could rise because of firmer economic growth, and that improvement is actually positive for the earnings and dividends of the companies that we invest in. So we are less concerned in this environment. In the long term, we are still convinced of the merits of investing in high dividend stocks. Over the long term, we've seen, of course, a steady appreciation of the Sing dollar against the Malaysian ringgit, and this would have benefited Malaysians who have invested in Singapore. As a globally competitive economy, it's natural that the Sing dollar will rise over time. So I would take any correction in the Sing dollar as an opportunity to invest in